Hi, everybody. Welcome back to my little DSW Capital series that I'm making at the moment. A quick shout out to Interactive Brokers because this is a broker that you can actually trade DSW Capital stock with. Fantastic news. Link in the description for that if you are interested. Let's jump into the valuation today. So I want to firstly look at the most recent trading update. Okay, so I'm not going to read this entire trading update. You can read it yourself. It's on their website. But let me show the key takeaways here and why the share price got punished because of this. So following a very strong first half performance, the historical weighted second half to 31st of March is being impacted by the wider macroeconomic conditions and uncertainties, which the board believe will result in the group not achieving current market expectations. They go on to say why several deal completions in these categories, the mergers and acquisitions category, were paused during the well-reported turmoil following the mini budget in September. This is in the UK. The board had expected activity to normalise. The political landscape, holiday season, not getting back to where they thought it would be, overall fears about the economy, just the anticipation of deals. A lot of this business is made up of the mergers and acquisition niche, which is about 60% of these little businesses that they own. So when mergers and acquisitions are down, which they were, revenue earned by DSW Capital is also going to be down because of that. So it's a bit reliant on mergers and acquisitions, and that's sort of what this trading update is about. They have had no further fee earners have joined the network since the start of October. Still is at 97. So good that it hasn't fallen away, but it means that they haven't been growing. James himself said this. He said, following a very strong first half of the year, the board is extremely frustrated by the recent confluence of events which have stuttered the previous excellent growth experienced by the group since the flotation. Whilst there is now a broad range of possible outcomes for 23, we have confidence in the robustness of our business model, strength of the balance sheet, and the ability for our partners to adapt. So yeah, the stock price got punished because of this. And how I've looked at it is that, yep, macroeconomics affect this business. It's pretty obvious, but we're only looking at over a short period of time here. This came out I think it came out in January. Yeah, 20th of January. So it had really only been tracking 3 months, and they were a bad 3 months, essentially, is what happened. But over a longer period of time here, has it broken? Well, not at all. This is not a broken business. It's just hasn't grown like it had been growing, essentially. It's going to be flat, maybe a little down on the 22 results. And that's not really that dramatic. I don't think it's half as bad of a business like the share price falling by half suggests. So this is probably why it's come up on my radar a little bit, because I think the price is going to be interesting. Now, regarding that valuation, there are a few different ways I could approach this. I could just look at it from just a straight up operating cash flow, which is because the cash conversion rate is about 100%. Operating cash flow, what is their price to free cash flow, which is right now about 8 times. And I can also run a DCF with that free cash flow number. And what I've done here in this DCF is, look, this is very rough. Don't read too far into this, but I've got the growth rate for the next 5 years. I'm assuming that things are flat for 5 years. How likely is that to happen? I would say it's unlikely that it's flat. But this factors in a little bit of a compression over the next couple of years, but not too many fee earners leaving. The economy as a whole, maybe a few additional ones added, a few leave. Zero growth is what I'm saying here in this valuation. And then for the 5 years after that, look, I've just pulled a number as 15%. Like, it could easily be 50%. It could be 0%. It could be minus 15%. I don't really know, but I'm going to say that this business model as it is attractive. It's going to grow, I think, because I think inherently a percentage of the accounting world is entrepreneurial. And I think a percentage of those are going to want some sort of support structure in place. And I think work-life balance is something that is desirable amongst the big 4 accounting firms. And I hope that this business can thrive into the future. And I'm sort of putting a number of 15% growth because I think it is a good model. I've got a pretty strong discount rate there of 26%. I've got a multiple we could pay after 10 years on the free cash flow, which is about 2 million after adjusting for a few things. The shares outstanding number, the total cash they have, saying I want to buy this about 65 cents if I want to get my 26% discount rate, which is very strong. And if you look at the current share price being around 70 pence, I should say, 70p, this is very close to where we're at right now. But the big assumption that I made here in that DCF is that I'm saying that the operating cash flow doesn't decline over the 5 years. I'm saying it stays flat overall. It can decline 1 year or 2 years, like is possibly happening right now, but I'm saying that number is going to stay stable over the 5 years. So how do we lose money on this when I think the price is really attractive? Well, if fee earners aren't happy and start to leave, this is how things start to go backwards. If the fees earned were also to decline and stay depressed, like I was sort of looks like it's hinting at is actually happening. Do I think that's going to happen for 5 years? I think that's unlikely. But by having declining fees, that actually might trigger fee earners to leave, and that then could actually be a negative pull down of the revenue, and that might not come back for 5 years. So that general large macro shocks I think is going to make things tough, exactly like the trading update suggested. And another reason this doesn't go well is they haven't been in a position before with quite a big bank balance. They just did this raise. So if this was used unwisely, they could blow this money on some poor decisions, some poor fee earners coming in that start to destroy the culture, or essentially we've got to trust management here, and that can always be hard and that can always backfire. Okay, so here's my best attempt at trying to summarize everything. I'm going to try to simplify it like Chuck Akre. Does it have a good return on invested capital? Yes. It's a 3-year payback period for new fee earners and acquired businesses. I think that's a good, strong return on invested capital. Do I think it has a long runway to continue to grow into? Yes, and I can imagine this working far more in England. 97 fee earners seems really small to me. This is a 16 million market cap company, which also seems small. It doesn't get much smaller than that, yet it still is reasonably diversified, which I like. I think the runway could be so much bigger. There are examples out there in this sort of licensing model that exists in the law space. Keystone Law, I think it's called, is the company that I'm referring to. And they're significantly bigger in the fee earners side of things. And that's just lawyers. So I think this has got at least similar growth potential, if not. Why can't there be thousands of fee earners? Why can't there be like hundreds of these little partnerships with 3, 4, 5, 6, 10 people working at them? I don't see why. There's thousands and thousands and thousands of small boutique accounting firms and financial businesses everywhere in Australia, as an example, in America and Canada. It's a big market. It's not a startup because they've been doing this for a long time now to get that diversification, but there's no reason this can't get huge. Now, the third leg of the Chuck Akre stool is, are management any good? I think so far, yes. I was wanting to know that they were going to loosen that dividend policy, and it sounds like James from the interview is fine with changing the dividend policy as need be, so that's good. I don't think they're going to be hamstrung to reinvest money if the opportunity comes along. And management have decided to not have any debt, which I like, so they can't really get into big bad issues there. And I think with his insider ownership, I think there's quite a big incentive. There's actually a huge incentive for this to be a bigger, better business. And lastly, we want to check if it's a good price. And I think it is. I think there's going to be some really good returns here, and we don't even need to see any growth. If it grows even single digits over the next 5 years, this is going to be a big winner. But please go through the videos that I've made already, because I do highlight a lot of different competitive threats and the macro issues that are involved here. And there are still a lot of things that could be quite problematic for this business. And it's not all sunshine and rainbows, just like the trading update suggested, but I think we're getting a pretty good deal. Now, I think it's quite a good opportunity, but maybe you're asking, why would this opportunity exist? Well, I think it's because of these things. I think it's because it is a tiny microcap company in the UK. So it's already very unknown and unfollowed. I think the trading update has spooked a lot of potential investors. I think people hear financial services and think, oh, that's too hard. That's a too hard basket business. It's a bit of a black box. I'm going to stay away. Yeah, it's in the financial services business, but this is a licensing business, and that's a really powerful business model. Now, like I've said a few times, it's a massive bonus you can get. You can actually access this on Interactive Brokers, but most trading platforms aren't going to provide this. So even though they need the share price to grow is going to need retail support here, because managed funds and stuff can't get involved with this. It's going to be way too small. Private equity can't probably get involved. It's too small for them, not going to move the needle. So it's really for retail investors, but it's probably not accessible by most retail brokers. So having Interactive Brokers gives us a competitive advantage here, which I think is pretty cool. Link in the description below, remember. Okay, so that pretty much sums it all up. Now, if you've got any questions or concerns, please share them with me. I need to figure out why I shouldn't invest in this business. I need someone to help me pull this apart. I need your help. So if you can help me on that, I'd be very grateful. Criticize as much as you can. The more, the better. Please read Feathertop Capital's write-up, Tristan's write-up, if he still has it on his hurdle rate Substack. Watch all the videos. You watch management's previous videos as well on their channels. then hit me up with the questions from there. I'd love to pull this one apart with you if you want to dive into this one too. All right, that's the end of this little series. I hope you've enjoyed, and I will see you in the next video. Cut, 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 cut. I hope that noise wasn't too annoying.